You are.
Right. Welcome everybody to Mice Investing Live. I don't know if it's still you in the comments there, Jeff, but I saw you were waiting there for me. Sorry for the late start compared to the scheduled time, but I had some last minute things I was trying to get together, and also was getting distracted by some of the things I was doing prior to stream. But either way, got everything together roughly in time. So let's see, a bunch of things I kind of want to talk about today. A little bit all over the place. I've been doing lots and lots of work behind the scenes. Pretty happy with a lot of the stuff that I've been kind of getting together. I will say it's like almost like a lot of uh, my feelings throughout most of this year is I've kind of felt very, very rushed to do a lot of work. Um, Not like rushed in like actual actions with my portfolio necessarily. In fact, my portfolio has been pretty chill and hasn't really changed that much. I mean, I've gotten rid of positions this year, but I haven't been like rushing into a whole bunch of new positions this year. But in terms of like all the research I've been trying to do, I've really felt like, oh, I really need to rush. I need to get a lot more research done. I need to do this. I need to do that. I need to prepare to get a lot more of research into various industries and companies done. But a lot of the work that I've done in the last like month or two, I really feel like it's kind of culminated and gotten a lot of that feeling out of the way, and suddenly I feel like a lot more prepared, so to speak. Which is kind of what the purpose a lot of this research I've been doing has been. It was basically to kind of like be more prepared for when larger dips or God forbid a market crash comes. Because in previous market crashes, I haven't really had like um, a whole lot of preparation really for like a lot of the more quality names that would normally be dropping at that point in time, which kind of gets back to what I've been saying in a lot of my recent streams about why I've been shifting my attention to this kind of different approach to research, which is to say that I have been trying to avoid seeing that something is cheap and then going and looking into it because I see it as cheap initially. Instead, looking at things more from a qualitative basis to say what is the things that I want to own, regardless of whether it's cheap or not. And then after that fact, once I've determined that to be true, then determining whether or not I think it's cheap or not. And if it's not, well, then we just kind of move on, which unfortunately is a very time consuming process because that means you're building a larger pool of things that you would like to buy but you might not be able to buy right now, and obviously if you're looking to put capital work, that kind of has a bit of a problem. But over the course of this last year, I think I've kind of done a pretty good balance of um, getting more of my capital to work in positions that I'm kind of happy with in that frame. I still have a larger amount of capital I would like to put to work, like my index position right here is all capital I could theoretically put to work in individual companies. But I have been concentrating a little bit more into the names that I'm a little bit happier with in terms of their longer term opportunities. Some of them, the valuation isn't so great anymore, like Generac. Is definitely a little bit more richly valued now. Not extremely overvalued, but somewhat overvalued. And I look at it pretty much every day and wonder when it is going to be time to make a cut for it. But either way, um, I'm still holding it for the time being. But you can see it's over my allocation size targeting for the time being as well. So there is that. But either way, the point is these like top 5 to 6 positions or so, FG, PayPal, Generac, Fidelity, National Financial, um, in mode not as much, so we can kind of skip over that one. But and Hydric and Struggles, those particular 5 positions really fit my kind of like core views in terms of like the trends I'm trying to pay attention to, and I'm allocating pretty significantly to them. In fact, like come over to here and see if I just kind of highlight those names. That's 41 to 42% of my portfolio right there. Silvercorp kind of also fits in with those themes as well as does Osisco Gold Royalties. That fits in with my themes, and technically so does my holdings in the Gold Trust. It's not an individual company; it's just a Gold Trust. but it fits in with that kind of like thematic approach to construction of my portfolio. So if I just kind of add all those categories together, that's 52% of my money right there. So 52% or so of my money is allocated to things that I think have really, really sustainable 5 to 10 to 15 year trends behind them. Some of them more overvalued or undervalued than others. Like I said, Generac is moderately overvalued uh, versus like say Heidrick and Struggles or Fidelity National Financial is decently undervalued, or Silvercorp is decently undervalued. And then obviously I do have these other names that don't really fit in with those themes very well, but are significantly undervalued nonetheless. Like InMode is significantly undervalued. Lulu is no longer significantly undervalued, but it was when I was first buying it. In fact, Lulu doesn't really fit in with those themes and is also approximately fair value by my current estimate. So at some point or another, I will be thinking about whether or not I want to trim Lulu, and I definitely have thought about it. It's kind of currently running a little bit and has some decent momentum to it, so I'm not really in a hurry to. But the point is because it doesn't fit in with those themes, I'm not really looking to hold it until it's way overvalued. Whereas like Generac, I actually do kind of want to, like I might trim Generac, but I would keep it in the portfolio just because I wouldn't really want to get rid of it unless I found a better, more suitable position in a similar theme, or unless I thought it was like really, really overvalued. But okay, anyway, back to like I said, less theme focused ones. In mode's a little bit in and out. 'Cause technically, in mode sort of works with some themes I like to pay attention to, especially with like the kind of changes in healthcare spending over the course of the next decade that's expected. But to a certain extent, because of the fact that it's more of an aesthetic medicine, a more discretionary healthcare kind of product. It's not quite as perfect for that theme, but nonetheless, discretionary spending is something I expect to expand anyway. It's just not something I have a lot of strong confidence in as a theme. But Lulu kind of fits in with that as well. Mastercraft, and then Skyworks is a very different kind of company from I would say those three because all three of those ones are much more discretionary products focused. You can kind of like see how those are all in that category. They're very different, but discretionary products nonetheless. Like Lululemon is much more athletic focused, and so it kind of is a dual purpose thing where it's like it's somewhat discretionary, but it's also non-discretionary because it's clothing. So it kind of fits into both categories a little bit depending on the use case. And then, well, Mastercraft is luxury boats, uh, so very very discretionary. Anyway, so that's like 12% of my investment right there. Skyworks, very very different type of product, obviously, but it doesn't really fit in with the theme super well. It's kind of another in and out kind of one, similar to InMode, where Skyworks, technically the expansion of a lot of the Internet of Things, which is Skyworks trying to expand into, they is a very very kind of it works pretty well with a lot of the other themes I try to focus on. It's just not something I have a lot of core research specifically on. But Skyworks has a lot of other difficulties with it, obviously because of its Apple concentration. So partially just in that one because I see it as having upside and it's a company I understand really well. But obviously you can see it is in fact my smallest position. So but either way, the point is those four non not as theme focused positions, you see that makes up 13 to 14% of my portfolio, versus the like 52% of my portfolio that was more in those theme focused categories. And I have been kind of thinking about the distribution between these things going forward. And what I am trying to aim for is like somewhere between 2/3 and 3/4 of my money to be focused on those theme categories. So that's like 67% to 75%. We could call it 60 to 80% to make it simple. So like 70 is sort of like a base target. And like I said, we're at 52%. So that means I would ideally like to bump that up to more like an 18% more. But again, like I said, I have 26% of my money in VU as kind of like a placeholder for my capital beyond the amount of money that I want to hold in cash, which is really only about 5 to 6% or something like that. Well, I'm holding 5 to 6%. Technically, my target is 5 to 6%. I currently have 7 to 8% in cash. But the point is I could take that extra 20% to add to my more theme-based focused positions straight from VU if I wanted to. And obviously, I'm not fully allocated on some of those positions and over allocated on some of them. So either ways, I could theoretically go up to some of that capital. But this target size is supposed to take the capital appreciation into account. So I'm not really trying to go all the way up to that line. I'm supposed to be trying to go up to a decent amount of that line and then allow for capital appreciation to essentially fill up the rest there. Because once it's over the line, that's when I would theoretically be trying to trim. So you kind of want to let it move up to there based off of where you think fair value is for the company. But the point is, like I said, the distribution of my positions based off of those different strategies is coming along pretty nicely. 52% currently in the category that we want to have, somewhere between 60 to 80% of our money. So it's not quite there, but considering the other categories, like I said, was like 12 to 14% for like the non-theme focused positions. Well, I didn't even really get into saying that. If I want to have like 2/3 of my money in theme focused positions, I want to have approximately 2/3 of the remaining money, which means 2/3 of 1/3, which ends up being 2/9. That amount of money we would want in those other positions, which actually can't even remember what that fraction is off the top of my head. 2/9 is 22%. Yeah, that makes sense because 33%, 2/3 of that would 22%. So 22% is theoretically the amount of money that we would have in those positions. And like I said, I have about 12%. So while I need to have more money in my theme based positions, I also theoretically need more money in those other non-theme based positions. Now, again, that leaves another 1/3 of the theoretical capital to be placed. That's another 11% left over, which gets to basically kind of another category of positions, which I haven't really done as many in because that's usually I'm usually either not finding good positions in this type of strategy, or when I do have these positions kind of come across my radar from time to time, I'm usually more focused on trying to fix my portfolio and reallocate it because I haven't had as good of a kind of a strategy around which types of positions and which types of strategies I want to research and how much capital allocate to. So now that I've kind of like really done a lot of work and thinking about that, point is now I'm willing to kind of like delve a little bit more into a little bit of a different kind of strategy. And that is to say that this third category, which I would allow for much smaller positions, up to maybe about, like I said, about 10% of my portfolio, would maybe be much more of like deep value, speculative plays, very, very small caps, probably, some things like that, things that don't have very good quality characteristics to it, but might have serious multi-bagger potential to them if you're willing to experiment with them. So I haven't done as many of those types of positions in my portfolio. I've done some research and some valuations on positions like that on the channel from time to time. People have requested them from time to time. And so I mean, I have a definite pool of some ideas already to go look into, partially because of that. And I have also good screening methods. And so that's where kind of like the other methodology comes into play, where like I've been talking about in my research methodology, I want to try to focus on determining good quality companies first and then waiting for the valuation to come to me, rather than the other way around of determining companies that look cheap and then determining whether or not I think that they're a good enough company to also put in my portfolio after that fact. So the point is that that last 11% of the portfolio, or really that last 33% of the portfolio, but especially that last 11%, we're willing to kind of ignore those qualitative characteristics and really just look on a purely quantitative basis of just how cheap they are. So I've been talking a lot about this one particular strategy that I've been developing over the course of this year, but it's not to say that I'm not going to be doing other strategies. It's just that I've been trying to really focus that new approach because I want to have the majority of my capital allocated, invested that way. And like I said, I'm definitely feeling a lot better now and a lot less rushed in that approach now that I've gotten a lot of this this industry research done, and I put together pools of companies that I'm looking at in different industries, and I already kind of have a roadmap for what I'm going to do further from here, which I'm going to go through a little bit of that today. But that's getting me into a position where I am going to be able to kind of like relax essentially on that particular strategy because it'll kind of already be in effect. So I can then experiment a little bit more with some other strategies, and this kind of approach with the thematic research for determining quality companies works well with also the strategy that I've kind of already developed for my my index fund holdings, where I do hold a significant amount of my money in the index fund as kind of a placeholder, and that also takes a little bit of the stress off my back when to looking for new companies, because I can kind of essentially not feel the need to swing at every pitch, to use the baseball metaphor. I can kind of like take my time looking for the right positions. And that's worked well for me for over the course of the year, as I've kind of concentrated more into these positions that I have a lot more confidence in. Though, like I said, they can't last forever, as I've been talking about with the generic position. I already definitely significantly want to trim that. I'm considering potentially like trimming about a third of that position, because really that's generally, if I'm going to trim something, I kind of want to trim it pretty significantly. So about a third is kind of the amount we kind of want to do going forward. But the point is I feel like I've done a lot of work this year, and that's kind of put me into a position to feel a lot more relaxed in terms of how much work I need to do on a regular basis in the next few months, because I've kind of like set everything up. I've set everything up so that as market dips happen, I already have like my targets lined up. So now I can kind of go looking for different types of targets. Like I said, some more deep value stuff. So anyway, but before we get kind of like past that point, I definitely still kind of want to talk a lot about the thematic stuff. We're not talking about that today. We just like I said, I definitely have been just kind of expressing my feelings about how my portfolio management is going. Here's our kind of general theme list that we've been talking about a lot. I've gone through my quality list for miners and REITs. And then today we're going to be talking about utilities and home builders, which we talked a little bit about utilities last time. I had already done some of the work on that, but I've actually completed the list on that, and also done valuations for a lot of that. In fact, whoops, I actually pull the dashboard up. To the dashboard. Here's the main dashboard, which before I go any further, I will say if you're watching live or on the replay, please like the stream. Liking the stream will help attract more viewers to the channel. Subscribe to the channel if you haven't already. If you've done both of those, consider joining the free Discord. The link is in the description below. It's also the pinned comment in the chat. Join the free Discord. You can be part of the daily discussions that we have going on of what's going on in our portfolios, the actions of major investors, um, random jokes about what we're doing with each other, or analysis of various companies, major investors, and interviews with them, uh, uh, conferences and interviews with management, um, sharings of academic theories on finance, all sorts of things like that. Come be part of the regular discussions in there. I will say if you do join, you're not going to be able to see anything right off the bat. You do have to wait for one of the mods to let you in. You can ping one of the mods to let you in, or just wait about 24 hours or so and somebody will let you in. But please be patient. It's really to filter out a lot of the kind of spam bots and people who otherwise don't have the patience, and so it might not be worth having in the group. But the point is, if you do join the Discord, you can also get access to the free valuation dashboard, which is this link right up here. You can come this link right over here. And with that, you can get access to a copy of this page right here of the dashboard, where you can get a view of what I think the fair value is for a nice list of companies, the companies in my portfolio, as well as a handful of other companies whose models I have videos on here on the channel. But I do update my valuations after my video. So the point is you can see what I currently think they're worth, and some other details about them. Now, getting to what we came over here to do is to show you that I've also been putting together these industry watch list secondary pages, which is not going to be for free on that dashboard page, but it is going to be a resource that I'm going to be giving to people that have the premium subscription to the dashboard. You can subscribe to the dashboard for $5 a month, either through PayPal or Patreon. Both of those links are down below as well. It's not these secondary pages I haven't released yet for the current premium subscribers. We do have a few subscribers already, but that is going to hopefully be something that I'm going to be rolling out this week. I was just kind of waiting until I had a few of them kind of good to go. I didn't really want to start rolling it out if I didn't have a few of them already. But like here we have the gold mines watch list, where I've got, what is this, 11 companies I believe it was. Yeah, 11 different gold mine companies that I have done valuations for, as well as then we have the REITs page, which I think was also 11. So 11 different REITs I've done valuations for, which I believe I showed last time we had a live, but I've updated a bunch of them because I was kind of like early on in some of the rudimentary evaluation assumptions for that. So I improved it a little bit. A decent handful of them are still significantly overvalued, but now there's a handful of them that are at least fair value that I've kind of determined since then. But I feel a little bit more confident in the kind of spread evaluations that I have here now. But then today also I have here to show is the utilities, which is 8 of them, I believe I have here. Utilities, it's very hard to find a lot of them to be very fair value, which I still might be looking at some of the assumptions and kind of thinking through some of them. Maybe some of the assumptions I have with some of these worst ones are just way off. But part of me feels like maybe this isn't too crazy. Just also taking a look at kind of like what's going on with the ETFs related to them, because that's one thing I did have also added on these industry pages is down here below. I do have the major ETFs that have these companies in them. So you can kind of track what's happening in terms of like the RSI or their price relative to the recent moving averages and RVOL on a given day. Just so you can get an idea, it's like, okay, well, if the company I want paying attention to is up 2% today, what's happening with the index? Is that it up 1% today? Is it kind of like a 2 beta move on that particular ETF, so to speak? And you can do that with the REITs as well. I have the REIT ETF here and then utilities ETF down here. But I bring that up because you can look at the utilities ETF and it really has been running a lot lately. So it's possible that me finding a lot of these to be significantly overvalued isn't so crazy. Maybe it's just that utilities are very overvalued. I don't know. But the point is if you do them as a group like this and you find a consistent trend in there, maybe there's a consistent trend within that industry in terms of valuation, or maybe there's some sort of consistent trend in terms of the mistake you're making for the valuation assumptions. That's something you should always consider. And it's I think one of the values of doing the analysis that way. Because like, for example, if we come over to the gold mines, obviously you can see that there's a consistent trend that I'm finding gold mines to be cheap. Now you could say that maybe as a group, they really are cheap. I would also point out that the ETF down here is definitely not very overbought on its RSI. So using that kind of like that same analysis, you can kind of like say, well, maybe they are actually cheap. Maybe that's not an unreasonable perspective to have. Or maybe the assumptions that I used commonly through all these valuations got me to that similar assumption. And I bring that up with gold mines in particular because there's an obvious assumption that I make that is going to lead to that, which is to say that my projections for these companies does involve gold prices going up over the next 10 years. I think the amount that I project gold prices going up is a reasonable amount and not a crazy amount, but it is nonetheless a projection that assumes commodity prices are going to go up over the next 10 years, particularly for gold prices. So the point is another person, if they just use today's gold price and they only assume that it was today's gold price for the next 10 years, then they wouldn't get the same valuation assumptions here. They might find them to be more of a spread between fair value and overvalued, or maybe they might find the majority of them to be overvalued. But that's my point, is that the assumptions you make obviously is going to affect what results you get. So if you do an industry as a group, you might find that there's some sort of assumption you're making that's common to that industry for better or for worse. So I bring that up with gold mines because I'm consciously aware of the assumption that I'm making for these companies, which is to say that like if you're looking at this and if you don't have the same belief about gold prices I do, then you probably wouldn't want to take these fair values as a given. You might want to discount them to a certain degree based on that and be like, okay, well, Midas is pretty bullish on gold, so I should probably I should maybe take his valuation with a grain of salt since I'm not so bullish on gold. That like might be one way to think about it. Versus utilities, it's like, well, okay, Midas appears to be pretty bearish on utilities. Maybe there's something in the way he assesses them that makes it so that is that way. But it's also possible that the assumptions I've made in both those industries are totally accurate. But I'm pointing it out. You can see that there is a common trend here between them. REITs, like I said, there was a common trend. I was finding them to be massively overvalued. But now after I've kind of changed some of the assumptions around, I get a little bit of a better mix. You can also look at the averages that I have down here down below. I do have the averages, the cap weighted average and the median for a variety of the statistics down here. So you can see, like, for example, on average, I have 9% of upside for the gold miners, 12 to 13% on a median basis. But the cap weighted basis, it's actually about fair value, which is an interesting result to get the difference once you cap weight these values right here. And then I do that for the REITs as well. I find it to be about 10% overvalued on average, 18 to 19% on a median basis, and then 14% on a cap weighted basis. 9 to 14% is not too crazy of a distance from fair value. It's kind of within the range where I don't really like double take it super hard, which is one of the reasons why I like to say, like, as long as I've got like a decent spread between it, that's not too crazy as far as I'm concerned. And then also utilities though, coming over here, you can see 37% on average, 33, 34% on a median basis, and then 30 to 31% on a cap weighted basis. So no matter how you spread it, uh, I'm finding some pretty overvalued numbers for the utilities. But like I said, I threw these together relatively quickly. The assumptions on these are relatively simple sets of assumptions. So it's possible that if I kind of look at them all parallel with each other again, I might find something in the assumptions that I'm kind of like screwing up. But nonetheless, here's my first findings on utilities. Dominion looks potentially like one of the better ones to potentially throw in the portfolio. Not particularly great, only 9% of upside and 7 to 8% of a COGR. But the point is, if for some reason you felt like you needed utilities in your portfolio, Dominion might be a decent play to go for. Natural gas as one of their larger focuses, though they were actually a spread between stuff, and they also had nuclear as well. But I'm pretty sure they had a decent spread of all the kind of utility fuel sources. Southeast as a large focus, but I believe they're also spread between the Southwest and some of the kind of Northeast as well. You'll notice that here, like in these groupings, I kind of have the details for a lot of them. Usually it's some sort of like category as well as maybe some geographic information. Like for the REITs, for example, I have like the REIT category it's in plus the geographic mix. It's not that those are the only categories or the only places that they do business. It's really just those are the, I think I generally used 20% and up as kind of my cutoff point. It's like whenever a category had 20% and up, I threw it in the details thing. So it kind of just gives you an idea of like where their larger focuses are for these categories and these geographic regions. And that's true for how I kind of like put the information in for the REITs as well as for utilities. And then I also added a column for their current insider numbers because that's at least kind of gives us an idea of like some information about management, which you can see for REITs, the averages cap weighted medians for the insiders is not very high. On kind of a typical basis, we're seeing like 75 basis points is kind of like a typical number for insiders for REITs. Utilities, even less so. We're seeing more like 30 basis points. And then for gold miners, however, it's much more significant. 7.5 on average, 0.7 for a median, 2.4 on a cap weighted basis. So 3.6, maybe kind of typical number between there. So you see some companies with like almost no insiders, and then other companies with like massive shares of insider ownership because it's like founder led mining company or something like that. So very, very interesting spread between what you see for insiders on the miners compared to other industries like that. Mr. Beast, what's up? How's it going? No chat. And then you may also note down here, I do have this builders page, which I haven't really actually started to fill out yet. In fact, here it still shows some REITs here because that's just when I copied the page over. But I have started doing a lot of work on the builders. I just haven't gotten to the point of doing the basic valuations for them. Pretty much going to start doing that here very shortly. In fact, if we come over to the research page here, I have kind of like the utilities research that I put together, which I kind of explained all the criteria I did for last time. But then the builders page I have over here, which is unfortunately is a smaller list of companies. It is, what was it, 18 in total that I had for builders. I mean, there's probably some builders that I didn't have on this list. Somebody could probably bring them to my attention. But the point is 18 was really just the ones I found from like the sources where I was like trying to compile these lists of different industry groupings. But nonetheless, we worked with what we had. And then I've already kind of done all the criteria for it, which we'll get through it in a second. Mr. Beast comments, Mastercraft look good. Yeah, man, Mastercraft does look good. That's why we've been buying it. Coming back over to our main dashboard page, it is the most undervalued of the companies that we have on this dashboard here. Very undervalued. Net cash as well. So relatively low risk. Decent amount of shorts within it, partially because of how discretionary it is. So that's one of the reasons that it's kind of been punished lately. But 9% of shorts currently means 9% of shares that have to eventually be bought back at some point in the future. So you can always look at shorts as a contrarian signal as well. It has been, not super cool lately. So on kind of a technical basis, I wouldn't say it's necessarily super chill in the short run, but it also does have good momentum. I'm pretty happy with my current position on it. I could get more, but I also kind of want to just let it run with where it's currently at. So it's one of those positions where it's like I could add more to it on some significant pullbacks, but because of how discretionary it is, and because of it not really fitting into the kind of like thematic allocation that I've been trying to do a lot more of lately, it's not really a position I want to have a gigantic position of. It's one that I definitely think is super cheap, but it's not one that I feel like I have a whole lot of confidence on how long it's going to take for it to come back to fair value. It's like, who knows? Maybe it'll spike back up in short time, but who knows? Maybe it'll be kind of perpetually cheap, and it'll have to kind of drag its way upward as earnings improves over the next few years or something like that. But nonetheless, let's see, what am I currently at? 2.7% of my portfolio currently. My targeting system says I could have up to 5.1%, but that 5.1% would take capital appreciation into account. So if I think it's currently 67% of upside, then on the 5.1%, I would actually probably really only want to go up to like 3% or 3.5% in terms of allocation if I wanted it to be at my allocation size at fair value. So that means I could still add some. I'm only at 2.7%. So it means I could maybe add close to 1% of my portfolio more into Mastercraft if I really wanted to. But and I am down on, oh no, I'm not down on it anymore. That's right. I actually am up on it now a little bit, only 4%. But I was down on it for a while, so that's why I assumed I still was. So maybe if dipped back below my cost basis, maybe I would add to it a little bit more. But nonetheless. Mr. B says, I would buy Silver Corp tomorrow, I think. Yeah, Silver Corp is also a pretty decent opportunity as well. Going back over here, you can see it's number 2 on that list, which I bought in Silver Corp recently on one of the days where it had one of its larger drops. The day where they announced their convertible bond offering, and it took a larger drop, but it's had some more significant drops since then as well. So it's one of those things where um, I'm bullish on Silver Corp, and it fits well within my themes, but I consider it to be one of the higher risk opportunities in my opportunity set. I don't consider it a super high risk opportunity necessarily, but it's not a low risk opportunity. So it's one of those ones where it's like I would technically prefer to allocate more to lower risk mining operations if I could. This is just one of those high risk, high reward opportunities, and so we add when we get some good dips on it, but because of just how good of an opportunity it is in that sense. Mr. B says he's adding TLT too. Ooh, good luck with that. I was gonna maybe share some stuff depending on how far we got with certain things here today. I have a bunch of the stuff I could share today, and it kind of depends on where the conversation goes. But to be honest, I'm a little bearish on TLT. I'm not so sure that the long end of the curve is gonna be coming down necessarily. Then the short end of the curve is probably going to keep coming down a little bit because yeah, the Fed is probably going to keep cutting rates a little bit, at least in the short run. But I don't necessarily think that it's going to be the long end of the curve. But that's a whole kind of separate topic. Jack, China focus, sell. Key people, Rui Feng, chair, CEO, sell. I assume you're being sarcastic there, but yeah, Rui Feng, I don't know. From what I've read and looked into of Rui Feng, I have a decent amount of respect and kind of hope for the guy. He definitely seems like he's pretty good at mining operations and has had some pretty great successes. So I feel pretty good with him personally, and I do like the reasonable level of insider ownership for them. Obviously, it doesn't stand up to some of these fat chunks like Matella or Equinox or Orla, so it doesn't look very nice compared to them. But 3.8% is nothing to sneeze at, nonetheless. SEB, you think so? Classic one for me. Oh, I looked at them and oh, this wasn't even the one I was thinking of. Seaboard. Oh yeah, okay. I can see why you say it fits my profile a little bit. I was kind of saying at the start of the stream, it's like I've been kind of focusing a lot on this kind of like more qualitative focus for a lot of my portfolio, but I am starting to get things more in place where I think I'll be looking at some more deeper value cuts at some point in the near future. Allocating a lot smaller amounts of them, but the point is we are going to start looking for some higher risk, higher reward opportunities, so to speak. SSIS, interesting. Uh, anyway, where was I? Did I want to go further into? Well, I mean, let's actually talk a little bit about the interest rates thing, I guess, because I guess might as well since you brought it up. Going over here to, let's see, taking a look at the curve. So you can see obviously it is expected to have some more Fed cuts throughout the start and the end of next year. Expecting at least a couple more cuts for Fed the Fed funds rate to end up at a terminal rate of about 3.75 to 4% by the end of next year. Now, technically speaking, whenever you look at these probability implied curves, you have to keep in mind that technically it's a spread between people that are going to be betting a lot lower and people that are betting a lot higher. So it ends up being a weighted average. And so it's kind of something you kind of have to keep in mind, that it's not necessarily that like the vast majority of the market is literally betting on this exact path. It's really that there's a lot of people betting on a path much lower, and there's a lot of people betting on a path significantly higher, and then it ends up weighting the average around here. There's going to be people that are betting something similar to this, but the point is, it's just kind of something you have to keep in mind, that it's not literally just that projection on that basis alone. Now, like I said, that's fine. The Federal Reserve can do what it wants to, generally speaking, with the short end of the curve. But I do think the long end of the curve is where things get a little bit messy, partially because of just like the general term structure of how interest rates work, right? Like if coming over here, taking a look at um, the spreads, this is the usual yield curve spreads between different parts of the interest rate. So I have, for example, the difference between the 10-year and the 3-month. 3-month most closely correlating with the federal funds rate. Then we have 10-year and the 2-year, which is the yield curve spread that is most commonly referred to when people are talking about an inversion of the curve, is 10 to 2-year. But then I also have the 2-year minus the 3 months. So you can see on a very, very short term basis, even there is a yield curve that can sometimes invert. So you can see here's the different inversion points and the recessions that followed them, including the occasional partial false flags that we've had from time to time, and then our current situation right here. And recently, people have talked a lot about the yield curve uninverting, which is true for the 10-year minus the 2-year, as you can see right here. Zoom in, like the most recent year, or really, let's look at like a 5-year basis. So yeah, like the 10-year minus the 2-year has uninverted, but you can see the other two of these two curves have not. Which those two curves are on a shorter time frame, as I was kind of saying before. The 10-year minus the 3-year is technically a wider spread than the 10-year minus the 2-year, but the edge of the curve, the 3-month, is so much lower than the 2-year that it ends up being kind of like a lower duration because of that spreading between it. And then the 2-year minus the 3-year is definitely a much shorter spread time frame basis. So those two have not uninverted yet, and technically I wouldn't really say that the uninversion is fully uninverted until we really get all three of them to uninvert, because as I kind of was showing before, depending on what point in time you looked at, one or the other was slightly more important or had a little bit larger effect, or uninverted quicker, or inverted sooner than the other. So you really kind of want to look at like all three together to get a kind of a clear picture of what's really going on with interest rates. Now, the reason why, like I said, like the Fed can do whatever it wants with the 2-year, and that's one of the reasons that well, not with the 2-year itself, they do what they want with the Fed funds rate, but the 2-year is so much closer in terms of duration to the Fed funds rate that it responds so much more to the 2-year. But the 10-year is so much further out that it doesn't really respond to what the Fed does on any real basis. And you can kind of like see that what's happening here is not that the when it uninverts like this, it's not that the 10-year goes back up above the 2-year. Generally speaking, it's generally that the 2-year is going down below the 10-year. Which is kind of exactly what we've had in the last month or two. The Fed starts to cut rates, and then the 10 to 2-year spread starts to uninvert. We haven't had that on the other ones yet, like I said, but that's partially because there's still some discrepancies within the credit markets themselves. But if you look at then at those kind of like similar those similar parts of the interest rate curve and but look at them on a kind of like an actual yield over time basis rather than looking at the as a spread. Here, right, I have the federal funds rate on the blue line, the 2-year treasury on the red line, and then the green line is the 10-year treasury. You can see how closely they go in line with each other. And generally speaking, you have the blue line on the bottom, the red line above that, and then the green line above that, which would be the normal curve spread, which is a little hard to see because they're kind of crossing over each other. But the point is when you have those uninversions, it's when all these get very, very close together right before a recession, and then they get wider again, much further apart from each other as the recession starts to alleviate. And that's kind of what you generally see. And then laid over that, what I also included was gross domestic product. Now, this is the nominal GDP year over year basis, and it's not real GDP, so it's going to be a little bit higher on a percentage basis than what people usually refer to on GDP. The reason why I brought this up is because the 10-year and GDP are generally very highly correlated with each other, because GDP is essentially growth plus inflation. It's a real growth plus inflation. And then the 10-year treasury is an inflation compensation plus a real growth compensation. So they are effectively compensating each other for the same thing. But really, that's true for all the interest rates. That's true for the 10-year and GDP. But GDP tends to correlate with the 10-year the most because it's more of a smooth average of what's expected of the future, whereas the 2-year has a lot of short-term expectations because of the actions of the Fed, as I was kind of talking about. So the reason why I kind of bring all this up is because thinking about this, then you look at these spreads and say, okay, well, what's normal? If we're expecting interest rates to become normal again, what would we generally be expecting for interest rates going forward in a normalized interest rate environment? So we can kind of maybe we can kind of reverse engineer to figure out just how realistic or unrealistic the expectation that we have on the Fed funds future curve is going forward. So basically what I did is I downloaded this data right here and then performed a bunch of statistics on it. I did it in Excel because Excel, some of the statistics package for Excel is better than Sheets. So it's one of the things I use Excel for specifically. So here I have like the Fed funds rate going back to 1976 on a quarterly basis, the 2-year, the 10-year, as well as nominal GDP. And then I took those spreads between them, the 2-year minus the Fed funds rate, the 10-year minus the 2-year, and then nominal GDP minus the 10-year. So get an idea of like, okay, what is those normalized levels on that basis? And then I ran the statistics package, like I said I was going to, on GDP, so I could kind of show you what I meant. And I ran it on a whole bunch of different things. I ran like a whole bunch of different versions of it to kind of try to find what the strongest correlations were. And the strongest that I found was a 37% correlation with 13% explanatory power for GDP using just the 2-year treasury and the 10-year treasury as variables. And then here I have the t-stats and the p-values. These are statistically significant values, which, you might say, okay, well, 37%, that's not really that great of a correlation. And I would say for nominal GDP on a quarterly basis, being able to do anything, I would say is pretty impressive all around. Yeah, that's not a very high number, but in terms of statistical significance for the type of data we're working with here, I'd say it's pretty impressive. Oh, for what I was also forgot to say, this isn't a in time correlation. This isn't saying that, oh, they're correlated with each other at this moment in time. This is a future correlation. This is 5 years forward. So here you can see it says 173 observations. If I come over here to the data set on any one of these columns, you'll see that it's 193 data points. And that's because they're offset each other for 20 data points and they're quarterly data points. So that's 5 years. So really, it's actually an offset correlation where we find that statistical strength. So it's basically saying that if you look at the 2-year treasury and the 10-year treasury yield where it is today, you can get an estimate that is 37% correlative with nominal GDP 5 years from now, which is, in my opinion, pretty impressive. So that's exactly what I did here. I took the regression factors that it gives right here and ran that on the 2-year and the 10-year treasury as it currently was, and that gets me 5.99%. So what I would expect from nominal GDP 5 years from now would be 5.99%. And again, that's only 13% explanatory power. So you could easily add lots of other factors to this model to maybe to build a much more accurate thing. But nonetheless, I thought that that's pretty good for just looking at interest rates. Just interest rates alone we can get an estimate based off of that. So then what I also did is I like I said, I took these normal spreads between the Fed funds rate in the 2-year, the 10-year in the 2-year, as well as nominal GDP in the 10-year. And I said, okay, what is the normal spread between these? And I looked on kind of an average basis as well as a median basis. So like on an average basis, the Fed funds rate in the 2-year have about a 33 basis point spread. And then for the 10-year and 2-year, it's about an 86 basis point spread. And then for between the 10-year treasury and nominal GDP, it's about a 13 basis point spread. Now, that's the averages. I did look at what the standard deviations would get beyond that, and the standard deviations do go negative for the interest rate levels, which is to be expected considering it's an interest rate. So it's kind of floored at zero in a normal circumstances. So it's not a normal distribution, which means standard deviation is going to get you weird results. So it's not surprising to find those negative values there. So down here, I also did quartiles instead. We looked at the medians rather than the averages. The median difference between the Fed funds rate and the 2-year treasury is 43 basis points. Median difference between the 10-year treasury and the 2-year treasury is 80 basis points. And the median difference between the nominal GDP rate and the 10-year treasury is 8 basis points. So a very, very small amount of difference you can see for the GDP and the 10-year treasury difference. Like I was saying, they're highly correlative with each other. But then there's still these spreads that are a little bit larger and kind of more persistent. In fact, you can see that the quartile ranges that 50% of the time over the last 60 years, that the spread between the Fed funds rate and the 2-year treasury was somewhere between 5 basis points and 82 basis points, 50% of the time. And the distance between the 10-year treasury and the 2-year treasury, 50% of the time was 20 basis points to 152 basis points. Whereas the nominal GDP, it was somewhere between negative 162 basis points to positive 194 basis points. So you'll see a wider spread on that basis. So anyway, we have our projection of GDP 5 years from now, which is 5.99%. And then we have these normalized ranges for what we would expect the differences to be. That means we can kind of work backwards from our GDP to say, well, what would we expect the nominal 10-year treasury to be on the kind of the average range basis? And then I could also use the quartile range basis, or this is the quartile range basis, and this is the average range basis. So two different ranges where I would expect the 10-year treasury to be somewhere between 4% and 7.5%. That would be again 5 years from now. Or I would expect the 10-year treasury to be 2.67% to 9% on the average range basis. So you can see one of those ranges is a little bit wider than the other. And you can do the same thing for the 2-year treasury, working backwards, 2.5% to 7.5%, to maybe about 1.5% to about 7.5% for the Fed funds rate. And then likewise, the average deviation ranges are wider. And then what I did is I kind of took these two different methods and then averaged them together to get a kind of an idea between that. And that gets me kind of a central tendency assumption that I would assume on a kind of like a modified basis, we would expect the 10-year treasury to be like 5 to 6% 5 years from now. And we would expect the 2-year treasury to be about 5%. And we would expect the Fed funds rate to be about 4.6%. Again, that's 5 years from now. That's what we would expect. That's not necessarily what we would expect today. So if we come back over to the future curve, if the market is saying that they expect the Fed funds rate to be 1 year from now at about 3.75 to 4%, and we're saying we need it to actually be at more like 4.5%, which is closer to where it currently is. So we think that 5 years from now, the Fed funds rate should be basically exactly where it is, whereas the market thinks it should be about 1% lower, a little bit more than 1% lower. So it could go down and then back up, or it could be that it just doesn't really go down all that much altogether, or it could go down all the way back up to a much higher level and then back down. There's a lot of ways you could skin the cat. And again, also the statistics only correlated so much. So there's lots of other factors you could take into account. Now, I did try to kind of take that into account. I said, okay, well, if we take what the market currently has, like what is the current Fed funds rate, what is the current 2-year treasury, what's the current 10-year treasury, what's the current nominal GDP, and then use the normal ranges that we came up with to say, okay, well, what would it be normalized at if we just took today's GDP as sort of a given? Well, then we would actually find that we would expect the 10-year treasury to be at 4.88%, and then the 2-year to be at about 4%, and then the Fed funds rate to be at about 3.65%. Now, 3.65% is basically where the market is saying they expect it to go to. So you can see that the market is basically expecting today's GDP with a normalized range. That's what they've kind of projected into the Fed funds rate futures right here, is today's GDP level of 5% with a normalized range. So it all comes down to a question of if what you might expect to happen over the next few to several years in terms of what's going to happen to the 10-year treasury. The core question you have to ask yourself is, looking at GDP, do you think that the GDP rate is going to go up? The nominal GDP rate. Again, that you can, what you argue makes it go up is a different question, because it could be inflation or it could be real growth, or it could be a combination between the two. But the question is do you expect it to go up? And here's where that 5% is. Like I said, 5% is what GDP is currently going at, which includes real rate plus inflation. We can't pull the real rate up. Remember off the top of my head exactly what the real rate is currently at. 2.7%. So currently the real rate is 2.7%. That means that the inflation rate for that quarter was 2.3%. 2.3% for the implicit GDP deflator, which is usually a little bit lower than the CPI, just because of the way it's calculated. It's a slightly different measure of inflation. So 2.7% real growth, 2.3% inflation. That's what GDP is currently going at. What do you expect to happen? Now, my model gave me 5.99% for what GDP would be at 5 years from now. So I'm saying that I think the GDP needs to be 1% higher. It doesn't tell me what I think GDP, where it needs to be higher. It could be inflation that's higher. It could be real growth that's higher. It could be a little bit of both. In fact, I would assume that it would be a little bit of both, personally. I would assume that the real growth maybe pops up to like 3% or something, and then the inflation also goes up to close to 3%. Maybe it's like 3.5% real, with like 2.5% inflation, something like that. That's what I would expect. 2.5 to 3 for inflation, with 3 to 3.5 for real. Would be sort of what I would expect on that basis. But the point is the market is assuming that it doesn't go higher. That's what the market is definitely implying. The market is implying that it's gonna go down, consistent with the current GDP level, and so the current GDP level is going to stay at its current level. So maybe that's true, maybe it's not, but you can make your own assumptions based off that. Now, I kind of had all this data ready to go, obviously, so I had already pulled a lot of this stuff up to kind of show you guys today. But I started talking about it after Mr. Beast mentioned that he was looking to go long TLT. So that's where I would bring that up, and I would say, are you sure? Are you sure you want to go long TLT? I don't think it's necessarily a bad idea, but I would expect TLT to go down first before it would go up. It might go up eventually, but I would expect to potentially have to add to some down positions a little bit in that basis first. So what I did, like I said, I have my modified average assumption of where I expect these interest rates to be 5 years from now. And then I also have my assumption of what's implied with a normalized curve based off of today's current GDP. So it's a little bit of a mixture between what I expect 5 years from now versus what the market is implying right now. And then what I did is I took an average between those two things, which you can argue is just kind of a fun, an arbitrary thing to do. But it's basically like me saying that, like, what would I expect the market to move towards if it goes somewhere between where it's currently at and figuring out what I'm talking about. Like if it kind of corrects a little bit, it doesn't have to correct all the way, but if it basically just kind of like starts to move towards what I would expect to happen, like I said, because I'm talking about like a mixture between a 5-year average and a current market implication. So maybe like this kind of like mixture between the two would be something that you would expect of interest rates over the next year or two. So that's what I did. I took the average between those and I get 4.15% for the Fed funds rate, 4.53% for the 2-year treasury, and 5.37% for the 10-year treasury. You can see that implies gains for bonds for the Fed funds rate. So if you were to leverage up some Fed funds futures contracts or something like that, I would expect that those contracts might actually get those actually might be able to have some winning moves. But I see downward moves for buying the bonds of 2-year treasuries and 10-year treasuries. 10-year treasuries 20% downward, 7% downward for 2-year treasuries, and TLT is 20 years and up. So this only goes up to the 10-year treasury, but you can assume that this trend would continue, where it would probably be like 30% for for 20 years or something like that. So the point is that if I'm right, I personally am expecting 10-year treasuries to go up a little bit, and therefore I expect TLT to go down. And I personally think that the technicals on the US dollar and the 10-year treasury somewhat support this a little bit. I would expect potentially a little bit of a pullback from what I'm talking about in the short run. Again, you can ignore technical analysis a little bit, but I was looking at the charts of the interest rates and the dollar only like the other day, which is directly relevant to these factors. So I do think that the current market trends is supportive to what I'm talking about, where it's like we're currently getting a little bit of a pullback in yields. And I would expect the yields to pull back slightly a little bit, but then I would expect them to get higher a little bit over the next year or two. And then, like I said, we'll see how the dynamics have changed in a year or two. Also, because again, this is based off of current information, and the statistics aren't that strong to say that without some new information that they wouldn't change somewhat. But point is I'm not so bullish on TLT personally. I don't think it's a disaster buy necessarily. But I think you should be willing to see TLT go down 20% and then double your position. If that's what you're looking to do. Like that's what I would say. It's like, don't be willing to buy TLT unless you're willing to see it come down like 15 to 20%, and then you double your position there for the long haul. That I think is a potential strategy you could use with TLT, but I would almost expect that to happen based off of current interest rate and inflation and growth dynamics. So that's my spiel on interest rates. Like I said, I'd kind of prepared a lot of that stuff ahead of time, so you can see like I kind of already wanted to talk about it, but I'm kind of happy that Mr. Beast brought up TLT because it kind of gave me the runway to talk about it. And then coming over here, you can see taking a look at kind of inflation, what's going on with inflation. I do have a lot of inflation gauges right here. I have the CPI, I have the core PCE, I have core services minus shelter, so the super core as the Fed likes to call it, then the shelter itself, as well as the producer price index. So this is more like commodity input prices. And I bring up all these kind of to show that like, yeah, the CPI has come down pretty significantly. It's down around 2.5%, and people have been kind of celebrating that a lot. But a lot of what's pulling that down is these producer prices, which right here it shows it only at like around 2%, or my bad, it's on the, that's right, it's on the right axis. I thought that was weird for it to only be at 2%. So that one's on the right hand axis. So you can see that it's actually below zero. It's actually at like negative 2% or something like that. So there's a huge drag on the CPI being caused by that part of the chain. That number, the PPI, is usually a little bit lower than CPI. Like it's usually like if CPI is 2%, PPI might be 1% or 1.5%. So it's not unusual to see a lower number in general, but negative 2% is a significant drag. So the point is like while the PPI is below, I'd say about 1%, it's definitely in a very negative drag kind of scenario. So lower interest rates very much might actually pop this back up a little bit, and then that would have its impact on CPI. So then looking back at CPI, which is again at more like 2.5%, you can very easily see how CPI could be bottoming at 2.5% based off of that, as well as then there's also the shelter factor, which is in CPI, and keeping it from going down so much further because shelter services is at 5%. Now, there's a lot of evidence of reasons to believe why it on a go forward basis it would be lower than 5% because of new rental costs. But I do think there's also newer construction costs as well that people tend to not equally talk about in that part of the conversation. So while the shelter CPI will probably come down from 5%, I don't think it's going to be going down to below 3% anytime soon. Like it might come down to like a 4% or 3 to 4% kind of range at some point going forward. But either way, that's significantly above the 2% target of CPI, and CPI is like 30% this category. So yeah, you can see why, my opinion, CPI is kind of bottoming around 2.5%. I can see it actually maybe making it all the way to 2%, but then that really would be like the bottom. And then it would be going up from there. It wouldn't be averaging 2% on any sort of like 3-month or 6-month basis. Definitely, it would be bottoming and then going back up and averaging probably more like I said, I personally am expecting like 3.5% inflation kind of on a more go forward basis, personally, but we'll see what happens with that. I have I was significantly right on a lot of my
my guesses and my projections of what was going to happen during the tightening cycle. But once we kind of reached the edge of the end of the tightening cycle, where they kind of just started holding, that's definitely where a lot of the things I said was going to happen with inflation definitely haven't happened. But it's not necessarily that I think they're not going to happen. It's that there's been much longer lags on some of those effects than I've been expecting. So one of those things where it's like I've kind of given up on a lot of the timing aspects to a certain extent, but I still am pretty steadfast in what I expect to happen with inflation going forward. That's pretty much all the information I want to talk about with the economic stuff. There was a lot of economic stuff to we were talking about there. But you got me started. Once you get me started, it kind of just is what it is, and we kind of go from there. But we can come back and actually start talking a little bit more about the home builders, because we kind of briefly started mentioning that I had got that list together, but I didn't actually start talking about like the stuff I actually put together on that, the information that actually kind of went into it. So keeping with the trend I was kind of talking about with the miners, the REITs, and the utilities, I'm very focused on the geographic positioning of all the companies in various industries. So the regions of the United States kind of disaggregated the way that I chose to set them up. Southwest, Southeast, Northwest, Northeast, and North Central. And then I have an international category here as well, which uh, as I had said before, I'm choosing to kind of pick and choose my favorites for these regions the way I kind of choose to see them. So for me, this is the order of importance for regions, which is my own biases. Some other American would probably have very different opinions on which regions of the United States they think are more popping and more stable and more and have more exciting demographics and growth to them, or whatever it is that, or less risk, or whatever it is that suits your fancy. But the point is this is kind of subjective setup. But the point is, this is the way I choose to set it up. These are the regions that I'm more interested in focusing my business on. And so I have then kind of weighted an average ranking based off of who's doing business where, and then giving them a point uh, score based off of that. And then up here I have the median score, and then in green we have highlighted all of the companies that have an above median score for the geographic positioning of where they do their business. Now it's just the geographic thing. Then we have several other factors that we kind of took into account. I collected information about how many homes that they sold over the last 12 months, how many employees they have, how many homes they have in their current inventory, which most companies didn't give me the information in the actual number of homes. They just give you the value of the homes in inventory. But then you can figure out the average selling price using the home sold and the home building revenues. So we figure out the average selling price, and then with the average selling price, we can figure out the home's number in inventory. So we have the average selling price and the home's number in inventory, and then we use that to figure out what is their inventory turn. So how many homes do they sell in a year, and then basically how many times in a year could they sell their entire inventory is the how many inventory turns they have. So we have like I said, the geographic positioning as a weighting score. We have average selling price, which I chose to um, arbitrarily uh, give a point to companies that were selling at above median selling prices compared to the group. You could make an argument for both ways. You can make an argument for companies that are selling at below median prices, therefore having a competitive advantage because they have cheaper prices, and therefore consumers will be more attracted to them. Or you can make the argument that by selling at higher above median prices, that's an indicator of the quality of the homes that they're selling, as well as potentially the quality of the locations within the like specific city marketplaces, right? So I chose to opt towards that second option, where I'm going to take price as an indicator of the quality of either the home or the location, and therefore I've already taken care of the geographic focus in terms of where they do their business, right? So like as long as they're doing business in places where I want them to be doing business in, then in theory, I would want them to be charging higher than median prices, because in my opinion, I chose those regions because I see them as having higher levels of demand going forward. So if they're going to have higher levels of demand, you want to see higher prices. And also that means that theoretically speaking, if other companies have raised the prices to put them into higher class ranges, their prices not being raised would just lower the kind of class range in which they're in, which means people who were previously going to be buying cheaper homes would now be able to buy this home because now the prices have gone up a little bit. So in my opinion, I opted for saying that higher average selling prices was going to be a better thing, but you could just as easily argue it as a negative as well. Likewise, for the homes sold per year, I also took a market share number. It's easy to find out the information of how many homes are being sold in the whole country over the course of the last year. And so we have market share as a percentage basis. This is going to be an estimate. It's going to, because of the different ways the companies were calculating these things, that like if you had like all of the home building companies and all 100% of the market share, and you did this metric for all of them, it probably wouldn't add up exactly to 100. It'd probably add up to like 99% or 101% or something. So it wouldn't be exactly precise. But the point is, it's an estimate of their market share. And likewise, I chose to give a point to companies that had higher market share. You could, in my opinion, that gives them a larger sense of scale, which means that potentially they have certain competitive advantages with that scale, either cost advantages or potentially like financial advantages to that scale. But you could just as easily argue that you want to have a lower market share company because it gives them a larger potential for expansion. You can do your own qualitative analysis how you want. I'm just showing you how I did my qualitative analysis, and being clear where some of these choices are subjective, because some of them are subjective, and I'm super clear about that. Like it's objective in the way we're doing the evaluation, but the actual criteria that we put into the evaluation is not objective, right? Like that's kind of like the way a lot of this works, where it's like these are numbers, and so we're using numbers to try to give ourselves as objective an assessment of quality as we can. But like the specific things that we chose to focus on are super arbitrary, and therefore not objective. So yeah, market share, higher market share we give a point to, higher average selling price relative to the group we give a point to, geographic regions that we like being operated in we give points to, having a higher level of inventory turns, which means having a lower amount of inventory relative to your business, we give a point to. Now here's another one you could argue with. I took a look at their backlog. How many homes do they have in their backlog as a percentage of the total amount of homes that they sell in the last 12 months or in a year? I chose to reward a point to companies that had a low backlog relative to the homes that they sell in a year. Because to me, again, this is one of those ones where I think you can look at it either way. A high backlog means that they have a high amount of sales that are kind of already baked in, right? Like it's business that they've already won. So you could look at that as kind of a good thing. But there are cancellations. In fact, that's a metric that I didn't put into this information here, but basically all of these companies reported on their cancellation rates as well. That's like a major normal factor to this business. You have to understand is that people make orders that creates a backlog for the company, but then there's going to be a certain amount of that backlog that then gets canceled as the building gets started or before the building gets started, and that has its own downstream effects for the company. I didn't, like I said, I didn't keep that information here. You could just as easily have included a cancellation rate as an important qualitative factor like that. Like I said, they basically all these companies reported it, so it's like it was my arbitrary choice to only focus on the backlog part. And the reason why I didn't focus on the cancellation part is because I was choosing to say that a low backlog is good. I awarded a point whenever a company had a low backlog because that's the way I'm going to deal with the problem. I'm not going to focus on, oh, well, does this company have a low cancellation rate and therefore I don't mind them having a high backlog? Like you could make that argument, but I would rather them just not have a high backlog. How about that? That's simple enough for me. If you don't have a high backlog, then I don't care what your cancellation rate is. That's kind of the way I chose to think about it. So I awarded a point to companies that had a low backlog percentage relative to their sales. But like I said, you could totally have given them a point for having a high backlog, but then also included the cancellation rate and then given them a point for a low cancellation rate, right? So you could have like done both and taken care of that metric. But the point is, I chose to just give a point for a low backlog. Then all these companies also reported on the lots that they either owned or controlled through options contracts. The lots are basically land packages that they have purchased or they have maybe developed from the land themselves. So like sometimes people own land and they develop it into lots, or they purchase the lots after they've already been developed. Basically it's future land to build on. So like this is sort of like their runway of like how much more land do we already own that we're prepared to build on versus having to go buy the land to then build on, right? And some companies like to run on the model of having lots of land. And other companies like to run on the model of being what they call asset light and having little amounts of land. I chose to assess this metric by thinking of it in terms of years. How many years of homes relative to the most recent amount of sales that they did in the year? How many years of sales could they do with the current amount of land that they have? And that was kind of the way I chose to assess it. So some companies like to just by default operate with many years of lots, like they prefer to have lots of land on hand, and many of them are doing that development themselves, versus many of them are not doing that development themselves. And then many of them, like I said, prefer to be asset light, as they would refer to it in those circumstances, and only have like a few years of the land on hand. Now, this doesn't take into account where the land is. Like I said, like a lot of these companies also gave all sorts of other geographic information for this information. Like they didn't just tell you where they did their sales geographically. A lot of them gave you lots of this information on a geographic basis. So you can basically build up a separate model for each region. In fact, if you were to build a model for a home building company, that's basically what I would recommend you do, is that you basically build up almost like 4 or 5 different DCFs for the regions and then build them together. That would almost be like the appropriate way to do it for this type of company. But anyway, getting past that, the point is I awarded a point to companies that had lots of years of land. In my opinion, I would much rather the company have lots of have a very heavy balance sheet with lots of land. Ideally, it's in good places, so you would want to double check that to make sure it's in good places where they're actually going to use the land. But in theory, I saw some companies make the argument for how that lowers their overall costs and improves their overall margins, by having all that land, because it basically means that you bought the land years ago, and so you have kind of a competitive advantage. Where as land prices increase, you've already bought the land ahead of time. The increase in the construction prices of the homes, those prices you're passing on to the customer, but the land prices is one where it's much more of an actual capital allocation decision based off of the research I've done in the industry. So for me, I prefer having lots of lot years of land, and that's the metric I chose to use. Also for this number, like I mentioned at the start, many of these companies reported on it in terms of how much lots did they own versus controlled, because a lot of them would have basically purchased option contracts with the owner of the land, where it says that at some point in the next 10 years, I might want to buy that land for you at this price, right? It's an option contract. Land, real estate is very often done through option contracts. In fact, that's like some of the original uses of a call option was in real estate, funnily enough. But so the point is a lot of the companies had owned lots versus optioned lots, or and the total controlled number is the number I reported here. So I chose to basically see no difference between optioned versus owned. Technically, optioned lots means you would have to pay money in order to get the ownership, right? You would have to pay the premium to, or not the premium. You'd have to pay the strike price. You've already paid the premium, but you would have to pay the strike price in order to actually then buy the land. But you're only going to do it if the option is spiked, right? So the point is it's still a highly profitable thing. So I chose to not see a difference between those two categories and just report the total controlled number here. So those were the metrics I chose to assess the companies on. How many total is that? Let's see, 1, 2, 3, 4, 5, 6, 7. So you could theoretically have gotten 7 points for the home builders in general. The median score for the what was it? 23 companies? How many was 18 companies that we had in our group here? The median score was 3. You can see 3. Here's all of the threes. So you can see there's a handful of companies. What was that? 8 companies, 7 companies that are above median score, which is, like I said, we are kind of aiming for like 5 to 10 companies to be putting into our watch list once we kind of come through this stage of the process. So this is the ones that we basically would be doing the valuations on, which I started doing a little bit of the process for some of the valuations on, but like I said, I haven't really got them into the watch list yet. Like so far, like these are just placeholders REITs that from when I copied the page over, but I haven't actually put any of them in yet. But that's basically where I'm at, is that I'm probably going to do valuations on these 7 home builders. KBH is one that I've done valuations on before. In fact, I owned it briefly, but only ever so briefly before I sold it out, much to my chagrin, because home builders have gone on a run since then. DHI is another one that I've done valuations on in the past, though I didn't ever hold it. Um, uh, what else do I want to comment on? Sky technically is an interesting one. Sky is technically a manufactured home builder, so they're not really like a traditional home builder, and they didn't have the same metrics on some categories. Like they didn't give me the lot years numbers, for example. So that was kind of a weird little oddball one in the group that I chose to put in here. But interesting little group, especially in terms of like I said, those top grouping ones. Some of them are some of the larger market cap ones, and some of them are the lower market cap ones, which is pretty neat. So, and I put the little purple tag here on GRBK, which is Green Brick. I kind of point that one out in particular because I don't know, just when I was getting this information on the website, out of all of the companies, this is the one that really, really stood out to me in terms of just like their presentation, the information they gave, the way they really tried to sell it, their story. In fact, like they were the ones that basically sold me on the idea of having a lot of lot years, the idea of basically having a strong, not a light asset a balance sheet for this business model, but instead having lots of land up front and then developing it yourself. And you'll notice they're one of the highest numbers here, 10.8. Looks like LGIH has an 11. So there's one company in the group that had a higher amount of lot years than them, but they stand true to their name there. And you could argue that that's just the way they sell their business model in their presentation. But hey, they sold it to me. That's all I'm going to say is that when I was reading through their presentations and looking through their 10K, some of the stuff that the management said in the discussion area and some of the things that they showed in their presentation really convinced me of their particular version of the business model. And so I kind of like noted them because I was just like, they really stood out to me as potentially a really neat one. And by the way, they stood out to me when I was only like so far through the list. Like I I I'm pretty sure I had done them actually ahead of that. So I think I'd only done them when I had only done like half the list or so. So they stood out to me even when they were only done half the list, which means I couldn't really see what their score was yet because the score is based off of the medians of the rest of the group. So the point is like as you do the rest of the list, it changes the scores of some of the companies you've already done. So the point is I couldn't really see what their score was when I first did them, and I'd only done like half the companies at that point. And so it was kind of no surprise to me, but it was also a pleasant surprise to find out that they were one of the top scoring ones once I was done doing the analysis on all of them. So the point is like, yeah, Green Brick really stands out to me. I really kind of like them already. We'll see how I feel about them valuation wise, because who knows, maybe they're not good valuation wise, but point is they really stood out to me. Jack, top two are Texas focus and Colorado focus. I think this is just reflecting the coastal flight slash work from home trend. Top two, you mean these top two on my analysis, or top two based off of other things? Because that is going to reflect that to a certain extent because of the fact that they each get a point for the geographic regions that they operate in, and my own biases are going to be towards some of those regions. Like I am biased towards the Southwest United States and the Southeast United States. Like those are the regions that I'm personally biased towards. But I would point out that that's only 1 point for each of them. So that's 1 point out of the 6 that they got for that reason. The other points that they got were for these other qualitative reasons that have to do with their inventory and their backlog and the land that they owned and their employee counts and their market share and their average selling prices, right? So 15 to 20% of the rationale definitely would come from some of those reasons because I'm definitely influenced by those reasons. But the rest of it is just other qualitative factors, like the stuff I've talked about here. So they just appear to be higher quality names in my opinion. But yeah, so I'm curious to see what the valuations will look like for that. As I had kind of already showed over here, depending on which industry I'm looking at, kind of gets a different spread of valuations. Just based off of kind of the common assumptions that goes into me doing many valuations focused on one industry. So I'm gonna do miners relatively similarly. I'm gonna do REITs relatively similarly. I'm gonna do utilities similarly. So the builders, once I do the valuations for the builders, presumably I'm gonna have similar assumptions with them for better or worse. So we'll see how it goes on. Jack was looking at GRBK in 2021. Damn. I feel for you. Well, I mean, again, as I was kind of talking about, I was feeling the same way, like early 2022, I was looking at KBH. So, anybody who looked at home builders in the last few years and did not buy them is just beating themselves up so badly. And it's one of those things where it feels almost silly to even be looking at them now, right? Because it's just like you look at them and they've run so hard. But nonetheless, I, I think they have like all the tailwinds in the world, right? Like they are just one of the strongest potential winners on multiple categories of the longer term trends and themes that I'm focused on. So it's like, in my opinion, from an economic standpoint, they are just massive, massive winners for the next decade. Whether the stocks will be winners is a totally different question because that depends on the price. But the companies themselves are just set up to absolutely dominate for the next decade. So the point is if any of them are even reasonably priced, it could be a good opportunity. And then likewise, if we also get a crash at some point, these would be obvious ones to be trying to scoop up, even if it means staring into the economic abyss a little bit. Um, Obvious ones to potentially want to scoop up. So yeah, home builders, that's where I'm at with home builders. Next time we have a show, I will presumably have already done all those valuations and put them on the dashboard. But hopefully, since it'll be 2 weeks from now, I will also have already moved on to some of the other categories because I am also looking to do many other categories. Something else I've also done in the last week is kind of like filtered and sorted through a lot of these lists. I had mentioned that during the last show that I had made all these lists for all these different categories, but a lot of them were kind of like messy lists that included some companies that were sort of in line with the group, and other ones that were not in line with the group, and other ones that were multiple groups kind of like flushed together. So I haven't done it for all of them, so there's still a lot of work to do. But the point is, I've at least kind of cleaned up some other lists. So I have like this transportation infrastructure page over here, which really includes many other subcategories. So like there's railroads up here, but unfortunately there's not a ton of railroads in the United States. So that's the problem, is that like it's not going to be a very strong set of statistics if you try to do an assessment of just a handful of companies. So, but nonetheless, I have railroads here. Then we have more like road focused transportation companies, trucking companies, and things like that. So that's also a relatively small but much more similar subgroup. Then we have kind of like broader logistics and shipping companies. Then I also have kind of like pipeline infrastructure companies. And then a few of these were a few other ones that were, I can't even remember 100% off the top of my head what they were, but they were kind of like some other ones I at least wanted to pay attention to and note for myself. But the point is, you can see like I wanted to kind of do like a transportation infrastructure one. Specifically, I wanted to do railroads. Like railroads is the thing I really want to do. And I might still just do railroads, but it kind of sucks if there's only a handful of railroads to do. So I was kind of like, initially I was like, well, maybe I could do like a broader transportation infrastructure. And then I made a list of that. And then, like I said, you can see like how different some of the subcategories are. So I'm not 100% sure what I'm doing with this. Like I said, I might still do the railroads, even if it means it's a tiny list. Just because similarly, I'm bullish on railroads from an economic perspective. I'm not necessarily bullish on the stocks because that depends on price. But for the companies themselves, I do think that the next decade, in many ways, kind of belongs to them. So it's companies that I would like to know if they're even potential reasonable values now or in the future. Then I also have my employment services. I have a much larger group of that. So like here's a more cleaned up list of employment services companies. I have 17 of them. That's a big enough group I could probably do some stuff on. The problem with that is that then this starts to get into some of the lists that don't have as common of metrics to focus on. So like with miners, there was very specific metrics to focus on, like production numbers, years of resources, average all-in sustaining costs. Like these are very miner specific metrics that they all report. REITs likewise had all had like S&P ratings. They all had occupancy numbers. They all had remaining lease lengths. They all had square footage numbers that you could use. So those were metrics that you could use to kind of come up with these quality assessments they all had in common. Similar with utilities, they all had the allowable ROE numbers. They all had generation capacities. They all had transmission miles. They all had customer numbers. And so those are things that you can work with pretty similarly. Builders also had some stuff that was pretty similar. The average selling prices, inventories, backlogs, lot years. Those are all very, very common metrics. Like literally all the companies in the list all reported those similar metrics or something similar enough that you could work with. Once you get past that, like I said, I would expect the same for railroads. I wouldn't expect the same for the other ones necessarily, but for railroads, you can do the same. Employment services. Now, these are all consulting and service companies and employment focused ones, but they're all very different. Some of them are focused on hiring. Some of them are focused on payrolls. Some of them are focused on HR. Some of them are focused on research. So like they're pretty broad. They're all on focus on employment, but like the specific thing that they're doing in employment are all very different. So the type of metrics you're going to get that you can compare them on is just not as common. It's not as similar. There's some metrics you can kind of work with any type of industry and any type of company. Like for example, like you can find out how many employees they have, and you can probably find out how many buildings they have, but that might not be a very useful metric. Many industries, no matter what they are, might tell you how much square footage all of their buildings are. That might be useful. They might tell you how many orders or jobs they do in a year. If it's a consulting firm, they might have something like that. They might tell you how many customers they have. But the point is like it gets a little bit fuzzier in terms of trying to do something where you can compare all these companies to each other with the same metrics. So, like I said, that's one of the next industries I really want to try to do something for, employment services, just because I personally am very bullish from a thematic perspective on that industry. But it might be a lot harder to actually do this analysis for them for that reason. And I think it might be harder to do also electric focused industrials, which I have a cleaned up list for over here, which is another one I'm very focused on. And then I also have construction and building materials. And then I also have construction and engineering services. So I kind of have it separated out into like materials versus services, but two kind of like construction focused categories, one much larger than the other. So like all four of those are groups that I really want to do some stuff on, but like the metrics I'm going to be able to use for those four groups is probably going to be a lot harder, a lot fuzzier, and a lot less clean than it was for the miners, the REITs, the utilities, and the home builders. So that's where I'm at with the research. Like I said, I'm feeling pretty great about having gotten a lot of this work done. Like I said, I'm almost feeling like way less um, impetus to kind of like rush and get a lot of research done, which I kind of felt like that like a lot of this year. I've just been like, oh, I gotta do more research. I gotta do more research. I gotta do more research. Partially because like I knew that I wasn't happy with my kind of whole framework for research and how it tied into how I manage my portfolio. But I like redesigned all of that this year, and a lot of this research is kind of the results of a lot of that rethinking my approach. And it's kind of I'm very happy with what I've gotten through here because like it's kind of building almost like a map for how I can approach markets going forward. Because like I've the amount of analysis I've done on like how many companies I've done here is just kind of awesome when you think about it. It's like the miners over here. I mean, how many did I assess? What is that? 37 miners plus um 34 REITs. So that's 71 plus utilities is 30. So that's 101 plus builders 119. So that's 119 companies who I've gone through their 10Ks and their presentations to just focusing on a few metrics. You know, I wasn't trying to go through the whole thing and read the whole thing and understand everything about the company. I was just searching through 120 10Ks and 120 company presentations to just narrow in on a few specific metrics and then build spreadsheets for all of those. And then out of those 120, I then narrowed in to say, okay, well, what was the best? I think I had 11 miners, 11 REITs. That's 22 plus utilities. How many utilities did I end up getting? 8 was it? 22 plus 8, that's 30. And then home builders, like I said, I'm planning to do these 7. So that's 37. So I was able to in really not a crazy amount of time, honestly, like the amount of time it took me to go through all those 120 reports and presentations. Like I've been at it for a month or two, which sounds like a lot of time, but I mean the amount of juice I've kind of gotten out of that squeeze, so to speak, really feels worth it. Like that's kind of like why I feel so much better about my approach here is because we went through like 120 companies. We ended up narrowing in on like 37 companies that we thought were interesting enough. We did valuations on those 37 companies. We did on 30 of them, and then we're gonna do the other 7. But we did on those like 37 of them, and we put them into our dashboard here so that we can kind of watch them. So in a sense, we've more than doubled the amount of companies that we're looking at right here on our watch list. They're not as tight of valuations, but the point is they're also like focusing on industries we're focused on, so we can kind of see them on a comparative basis on an industry level. And then, like I said, I plan to kind of like double that from here. Like we have gold miners, REITs, and utilities, but I plan to fill out the builders list. Then I want to do an employment services list. I want to do electric industrials. I want to do building construction materials. And at that point, at that point, I will have gone through like 200 to 300 companies' reports and filings, and I will have narrowed it down to like 50 to 100 companies that will be in this list right here, right? So it's like you can see how we're kind of like expanding out the amount of companies that we can really have like a good understanding of where they stand within their industry, which gives us at least a decent understanding of how they are as a company. And I've kind of like I have started putting together uh a PowerPoint presentation that's basically going to include like basically an overview of like my whole investing process. I'm trying to like concretize. I didn't want to like write it out. I don't like to write essays that much, but I was like, fine, I'll make like a PowerPoint thing where it'll be like kind of like an explanation of my process. And it's not even like I'll share it with people who want it. But it's actually in many ways for me. So is it something like for me to like kind of like look at and kind of like think of as like a very specific approach where like, okay, this is my process, this is the thing I do, and this is like how I move from step to step. So like at least this slide right here is kind of like an overview of a lot of the stuff I've kind of been talking about, like this kind of approach. So I'll kind of like go into that. So you can see like we start at the top and you kind of like work your way down. And like here's kind of like the main topic, and here's kind of like specific things that you do in in as you kind of like do that part of the approach. And then this shows like how it affects the kind of the overall amount of companies of an analysis we're actually doing at any given point. So we start with just kind of like economic and market research. I mean, that could include like a lot of the stuff I was talking about with the interest rates and growth. Like you can do that on an industry level. Like, you're looking into industry levels. You're looking to see like what are the big players in the industry. What is the global demand and supply for a particular commodity? Like how does the mines work? How do home builders construct and then sell their homes? Whatever it is, economic market research. It can be anything. You want to focus on cycles, secular financial capital cycles, consumer trends, technological change, market economic sentiment, and really it's an infinite pool of ideas. Really, there's like an infinite amount of ways that can be expressed. It's really just like the broader set of random thoughts that you've had about markets and the economy and like things you could do with it. And the idea is to then take that and then form it into specific themes and trends, concretize that research into an idea that has a very specific um idea of like what is it going to impact. It has to have a very specific significant length, impact, and probability. Length meaning that it needs to be more than just a flash in the pan. It needs to be something that's more than just like a year or something that's just going to happen for like a season. You want something that's going to have several years of runway, ideally at least 5 years, but ideally close to more like 15 years, so that it's longer than your projection period. What is something that's going on right now that's going to be going on for the next several years? Maybe it's not even happening right now. Maybe it's going to happen in a year or two, but then once it happens, it's going to be happening for many years to come. And then its impact is going to be substantial. It's going to be impacting industries in a way that you can quantify, and the probability of it actually happening and happening for that length of time is also substantial. Like those three factors I think are very important. It needs to have significant length, significant impact, and significant probability. Significant doesn't mean majority. It doesn't mean that it's like for sure going to happen. It doesn't mean it's going to impact everything. Significant just means measurable, enough that you can count on it happening. And then ideally, you want to take the broader pool of ideas, the broader research, and I would say concretize it into just a list of themes and trends, 5 to 20 ideas of things that are happening. And I've kind of already showed like how this works. Like that's what this list is like, this is more than 20 ideas, but I'm not really doing things with all of them. I'm doing things with kind of like half of them. And that's like 5 to 20 ideas of things that I'm kind of focused on. I'm focused on the boomer retirement. I'm focused on the power grid weakness and expansion needs. I'm focused on millennial family formation and capital accumulation. I'm focused on the generational wealth transfer and the fiscal crisis and monetary debasement. I'm focused on the housing shortage. I'm focused on immigration and onshoring. I'm focused on e-commerce. Not so much on a lot of these other ones here, but yeah, I'm focused on the fourth turning and multipolarity and de-dollarization. I'm focused on energy transition. Yeah. So it's like you can see like these are the broader list of ideas, and then the ones that I'm a little bit more focused on are the ones that I have I have a stronger sense of the significance of their impact, a stronger confidence in the probability of them happening, and I also see them as having a long runway for existing for a long period of time. So that's like how you would concretize that. Like I said, 5 to 20 ideas. Just get yourself like 5 to 20 ideas of trends of things that are happening. You could do with five, but I think if you're willing to expand out where you can have 20 ideas or whatever, whatever works for you. It's like some people would probably prefer to have like a smaller list of tight knit ideas. Other people would probably prefer to have a larger list of ideas that are just a little bit more looser and not as overly specific. It's up to you how you want to form it. But then you move on to sectors and industries. Think about, okay, what are the industries and sectors that are going to be winners to those 5 to 20 ideas? You have your 5 to 20 ideas. Okay, well, who's going to win and lose? You also want to think about who the losers are, because technically there's investment ideas in relation to losers as well. But who are the winners and losers to these trends? Specific but numerous. So you like when I say name a sector and industry, you want to name a specific sector and industry of people who are going to win, and you have to have like a reason why specifically them, but not so specific that it's not numerous. So that gets back to kind of like my discussion here about like the railroaders. I only have like 5 railroaders on my list. That's not a very numerous list, unfortunately. And but electric industrials, unfortunately, isn't very specific. That's actually very broad in terms of the types of categories it is. So that's the thing, is you want something that's specific like saying home builders, or specific like saying gold miners, but something that's numerous like, well, like gold miners, or numerous like REITs, or numerous like electric industrial. So this thing, you want something that's both specific and numerous in terms of like when you're identifying a sector and industry. You don't want to say, oh, well, the industry I'm focused on is software as a service, defense companies that are focused on data analytics, right? Or something, because you're gonna have like 2 or 3 companies, right? Like you want something that's broad, so that it's numerous, but specific enough so that you can get this very industry specific information that you can analyze on. And that's the reason why you want those two factors. So the point is like you can probably, with your 5 to 20 ideas, you can probably identify 5 to 10 sectors or industries you want to focus on, which is as I've kind of already talked about, like I'm focusing on like 5 to 10 different industries or so. And what I would say is like you want to also try to get them to be affected by multiple trends. Ideally, you want to say, oh, well, this sector right here ties into this trend, but it also ties into this trend over here, and it kind of ties into this trend over here. So if you can do that, then I think that you really have a sector or an industry where it's like, yeah, this is a banger. This is something where we really want to focus a lot of our time and our energy on. So 5 to 20 ideas should be able to lead you down to about 5 to 10 sector or industry ideas. And then from there, we do kind of the process as I've been talking about, doing this kind of qualitative analysis, but qualitative analysis using non-financial measures of quality or risk specific to the industry. I try to avoid using metrics that are on the income statements or the balance sheets or the cash flow statement. The only exception to that, generally speaking, is revenue. But even then, I'm not using just the revenue number as it is. I'm using revenue as a ratio to something else to get some sort of like dollar per number. And that's the metric I'm really trying to focus on. So the point is like we're trying to avoid financial metrics, and the reason why we're trying to avoid financial metrics is because then that means the results we get from this qualitative assessment, this qualitative research, isn't going to be something that you can just screen. That's the reason why I'm doing it this way. Is the reason why you do it that way is because then some financial screening site can't actually get you that result directly. It can only get you, it can get you there maybe indirectly because maybe the returns are affected by these things, which is sort of what you hope for, but you can't get you there directly. And that makes, I think, that assessment much more valuable. So the point is with your 5 to 10 sectors and industries, you focus on the quality industry assessment, and that can probably get you to 25 to 100 companies. As I kind of already showed you, I'm already at like I've already assessed like over 120 companies, and then that narrowed it down to like 30 to 40 companies that were higher quality. And then 30 to 40 companies, you could probably cut those in half by assessing the managements of each of them. That would get you from 25 to 100 companies down to like 15 to 50 companies that have quality characteristics in terms of their assets, then also have quality management. So this would be also where you'd be focusing on their insider, the insider holdings and the incentive packages and things like that, within industries that you think are also quality. An industry itself isn't really quality, but an industry has tailwind. The industry has tailwinds or headwinds. So the point is like you find industries that have good tailwinds, you focus on the companies that have good quality. Within the quality companies, you then filter out to the best or half management. So I'm just saying like cut the list in half based off of the managements you think are best. And then from there, you can do valuations. Now, what I would say is like the management assessment and the valuation assessment, you can kind of do those two steps, in my opinion, in either order. You don't really need to do them in exactly this order. You could do the quality company assessment and then do valuations and then do quality management assessments. In fact, that's kind of what I've been doing. And that's the reason why I mentioned it that way. Like I have it listed in this order right here because I think it's almost would be better and less biased to do it this way. Like I think the results would probably be slightly better this way. However, I'm doing it this way rather than doing valuation first and then quality management after that is faster. So I've been able to do that a lot faster personally because like doing it this way, then I can really only focus on the quality management of the companies that are already closer to a better valuation. And the management assessment honestly takes a little bit more time because it's a lot more subjective. I have to like really look into their past, the records, the companies they worked for previously, look into their proxy statements and their insider holding stuff like that. It takes a little bit more time, honestly, to do this part of the assessment. So I like to kind of leave it sort of for last, even though I would say ideally you still would maybe want to do this before valuation. The reason why you would want to do it before valuation is because some of the stuff you learn here would probably feed into the valuation assumptions a little bit. So if you do valuation first, you might theoretically have to come back and do some adjustments after you do the qualitative management assessment. But either way, the point is, in my opinion, you could sort of do either of these steps in either order. But the point is, once you get through both of those steps, either way, valuation is, traditional valuation as we usually do it. But at the end of it, you're probably only going to end up with, after looking at well over 100 companies, you're probably only going to end up with like 1 to 5 companies that currently show significant returns as they currently are at their current price, right? And that's kind of where I've been. It's like I've done a lot of this research and really only found a couple of companies that were currently a good opportunity. But I now have many companies that are solidly on my radar. Well, I'm not going to like update these companies every quarter when they release new earnings, right? So like I'm not going to update these companies a whole bunch. That would be a ton of work to do so. Whereas like a lot of these other companies, like in my portfolio, I do update every quarter. But these ones, like I'm not going to update nearly as often. But the point is, I don't think I need to because I can at least compare them with each other, right? So like even if the valuations have shifted a little bit over time, the valuations have grown. As a group, they probably would all grow somewhat similarly, and so the comparative differences between the valuations, I think, will still be useful. And then if I'm really interested in one of them and one of them appears to be a good opportunity, all of a sudden, that's when I can really narrow in and say, okay, well, let's reassess, readjust, and make sure that the current numbers show it exactly as it is. And at that point, that's probably when I would be building a full model for the company too, because all these valuations are just relatively basic DCF assumptions as it currently stands. So that's kind of like the framework, my overall kind of like research flow, the workflow for how we're doing research on companies and industries. And then like at the bottom, I also included like this kind of other category too. Then after we have valuation in play too, then there's pricing, both relative and historical pricing. There's technical analysis. There's catalysts like buyback programs, corporate events, spin-offs, but potential buyout rumors. And then there's option strategies as well to take into account, right? There's many factors that can potentially improve the returns beyond just the valuation returns at that point. Then there's a lot of other factors that about how multiples could be re-rated in the market because of a variety of reasons, or potentially you could use puts or calls or something to improve your returns. But the point is like, yeah, this is kind of the general flow of how we get from just the broader pool of ideas about markets and economic research, as well as from hundreds and thousands of companies, right? So like when you're screening stocks, like that's kind of like the other approach, right? This is more of a quality first approach, valuation second approach, and then when you're screening stocks, you're starting with kind of pricing valuation first, and then considering quality aspects secondary. But either way, the idea is to start with the pool of like 60,000 stocks globally. I believe it is. It's like 60,000 publicly traded common stocks globally, something like that currently. So the point is, like, either way, the idea is to take that 60,000 companies and narrow it down, right? We're trying to like narrow in on a list of companies that's more manageable, broad enough for us to really have lots of ideas to look at, but narrow enough for us to actually like get something useful out of it. But also not arbitrary. And that's the other thing too, is like it's very easy to come up with like very, very arbitrary reasons for why you're not looking at one pool of companies or another. And that's one of the reasons, like I said, I've been trying to reverse this from the kind of price and value aspect first, quality second aspect, because I do think that it works better this way. Whereas like if you're focused only on the pricing metrics first, then what you end up doing is you end up running headlong into riskier situations, and maybe you can assess those risks appropriately, but maybe you can't. Whereas like this area here, we're trying to clear as much of the risks out of our way by essentially choosing what in the end are going to be less risky industries, less risky companies within those industries, less risky management teams within that pool of companies, and then the valuation it also works for itself. And so the point is, by removing those layers of risk, theoretically speaking, we've created for ourselves really, really good upside. And also, not to mention, this approach is very long term focused. A lot of this is very focused on creating opportunities that will work for us over a 5 to 15 year period, rather than something that looks cheap today and might get us really good returns over the next year or two. But then when we sell it a year and a half from now or 2 years from now, once it reaches fair value, at that point we have to sell it because it's not a high quality company and we were only in it because it was cheap. So these are companies where we will be in less of a rush to sell because we see them as having all of the potential further evaluation upside in the future. These are companies that have strong growing value characteristics, not just current value characteristics. Um, but as I kind of said at the start when I was talking about portfolio management, the goal is to focus like 2/3 to 3/4 of my money on this approach. And that will leave 1/3 to 1/4 of my money to allow for the pricing kind of approach as well. So we are going to be looking for deep value opportunities as well, not just using this approach. But the point is, we want the vast majority of our money using this approach, and then the few opportunities, the few smaller opportunities that we invest in a deep value approach will simply have to offer much higher expected returns in order to make them worthwhile within the portfolio, which will be the expected returns we'll be looking for within that space. Now, I kind of ignored it for a while because I was kind of in the middle of ranting on that topic, Jack, but I saw you ask that question. Wait, what happened with VSTO? Was that on your radar? It hasn't really been super directly on my radar. Like I've kind of paid attention to VSTO here and there because of owning Smith and Wesson for such a long period of time. But which, by the way, I've recently sold out of Smith and Wesson finally. So oh, was VSTO bought? Is that what you're? Is that what happened? I think that sounds vaguely familiar. I wasn't paying very close attention to them, to be honest. But oh, hold on. Oh, they weren't bought. They just bought somebody. Is it not pulling up a fuck though? Oh, doors. Strange. I haven't really been paying super close attention to them, to be honest. So I really couldn't tell you. But a quick little search. It sounds like they recently acquired something. I'm not sure what the arrangement was. But interesting. Interesting. Anyway, I do think that's pretty much it for today, though. We made it through pretty much all the stuff we wanted to talk about. Like I said, over the next couple weeks, well, really in pretty short order, I'll be getting through those builders. Like I said, I'll probably be working on that today, getting through some of those valuations, and then getting that into the dashboard. And then once I've got that list kind of put together, I plan to try to figure out how to roll out these secondary pages to the premium subscribers. So you should become a premium Patreon or PayPal subscriber, $5 a month if you want to have access to the premium version of the dashboard. Or you can stick with the public version of the dashboard, which the public link is in the Discord, which the free link is in the description below. Like the stream if you haven't already, by the way. Random call out on that. But the point is, yeah. So I plan to try to roll out these secondary pages to the premium subscribers. Fill out the builder page. Then I'm also gonna probably try to do the railroads because, as I kind of already mentioned, it's a very small list, so we can probably crack that out relatively quickly. Then I also want to try to get into the employment services and electric industrials, but those ones, like I said, are going to be a little bit trickier to do, so it might be a little bit slower going on some of those things there. And then, yeah, as I mentioned, I've also been kind of slowly putting together a kind of a PowerPoint which includes a bunch of random details about kind of like my investing approach. It's kind of what I'm trying to do is like a almost like a how to invest uh presentation, sort of. Not exactly like a how to invest because I'm not really trying to like teach from the ground up DCF and things like that, but just more like an overview of my thinking and my framework around investing on like every aspect of it, both from portfolio management, investment research, um, as well, sizing strategies, all of that. Just kind of like try to like concretize all of my thoughts on that, which will probably be an evolving process. It's not like it's necessarily all something where it's like, oh, I have it super figured out and I'm just trying to put it all together. Like I said, it's for me in many ways. So it's like a way for me to sort of like put everything down in sort of like a concrete way to refer back to for myself. But something I've been trying to do. So anyway, hope everyone's has a good week. Welcome to December. Here we are at the end of the year. Let's see what happens. See whether or not we get ourselves a Santa Claus rally or an exciting January or whatever the usual seasonality things that people typically expect are. But we'll see. We'll see what happens with that. But I'll catch you all in 2 weeks. Ideally, probably on that Friday will probably be when I stream next on my day off. So, all right, catch you all next time.